Hello dear learners. Welcome to the second video of the module 5 of the MOOCs entitled Rural Development in India. In this video, we will discuss All India Rural Credit Survey Committee 1951 and institutional sources of rural credit. The discussion on rural credit in India is incomplete without discussing the All India Rural Credit Survey Committee 1951. After India gained independence in 1947, agriculture became the backbone of the nation's economy, employing the majority of population. However, the rural economy was marked by low productivity, unemployment, and widespread poverty. Farmers lacked the financial support needed to adopt modern methods of cultivation, invest in irrigation, or purchase quality seeds and fertilizers. The situation was worsened by the fact that most farmers were small and marginal landholders with little or no savings, making them heavily dependent on borrowed money. During this period, the rural credit structure was dominated by moneylenders and informal lenders, who controlled nearly 90% of rural lending. Their high interest rate, manipulative lending practices, and seizure of land in case of default pushed many farmers into permanent cycle of debt and exploitation. Although cooperative societies and a few institutional credit channels had been introduced earlier, they lacked strong organization, financial support, and public trust. Many cooperatives were inactive or captured by local elites, failing to reach those who needed credit the most. At the same time, India was preparing its first 5-year plan, which placed major emphasis on agricultural development to ensure food security and support industrialization. It became clear to policymakers that without affordable, adequate, and accessible credit, farmers could not increase production or adopt new technology. The existing credit system was not only insufficient but also unfair, worsening rural inequality rather than reducing it. Recognizing this urgent need for reform, the Government of India and the Reserve Bank of India appointed the All India Rural Credit Survey Committee in the year 1951 with A.D. Garwala as its chairman. The committee was tasked with thoroughly studying the rural credit situation, identifying the reasons behind the failure of institutional finance, and suggesting a comprehensive strategy to build a strong and trustworthy rural credit system. Its work aimed to reduce dependence on moneylenders and integrate agriculture into the broad national development framework. The survey covered 600 villages and 1,27,343 families across 75 districts, and its 1954 report highlighted that the rural credit structure in India was overwhelmingly dominated by non-institutional agencies such as moneylenders, landlords, traders, and commission agents. Nearly 90% of total rural credit came from these formal sources, which led to widespread exploitation and high indebtedness. Institutional agencies like cooperatives had a very limited role and were failing to reach small and marginal farmers. The committee concluded that rural credit could not improve without strong government involvement. Its most famous recommendation stated that cooperation must be assisted, directed, and protected by the state. One of the landmark recommendations was the restructuring of banking institutions to increase rural outreach. This led to the transformation of the Imperial Bank of India into State Bank of India in the year 1955, expanding institutional credit to rural areas. The committee also advocated building an integrated credit system where cooperatives, commercial banks, the Reserve Bank of India, and the government work together. The All India Rural Credit Survey Committee became a turning point in India's rural credit policy. Its recommendations laid the foundation for a strong institutional credit network in agricultural areas. The committee insights shaped future credit reforms, including bank nationalization in the year 1969, priority sector lending norms, and eventually the creation of NABARD, that is National Bank for Agricultural and Rural Development, in the year 1982. It provided the first comprehensive framework for linking credit with rural development goals, such as modernization of agriculture, fair market practices, and reduction of rural poverty. Let us discuss the formal or institutional sources of rural credit in India. So this was all about the All India Rural Credit Survey Committee of 1951 in very nutshell, which sets the tone for reconstitution of rural credit mechanism in India. So in the last video we have discussed about informal sources of rural credit. Now let us discuss the formal or institutional sources of rural credit in India. So formal or institutional sources of rural credit includes commercial banks, cooperative banks, and regional rural banks, and other government regulated institutional arrangements which offers loans at regulated interest rate. There are three primary sources of institutional rural credit in India. They are the commercial banks, the cooperative banks, and the regional rural banks. Let us first discuss the role of commercial banks in rural finance. Initially, the role of commercial banks was not very active in promoting rural credit. However, after nationalization in the year 1969, they extended their rural branches and began directly financing the farmers and other rural communities. The number of rural branches increased from less than 25% of the total in 1969 to about 34.82% of the total in March 2022. Since nationalization, branch expansion and deposit mobilization have both increased. An important aspect of rural credit in the post-1969 period has been the priority sector lending, whereby rural banks had to direct a substantial proportion of their credit to rural areas. Commercial banks play a very vital role in supplying rural credit, not only to agriculture but also to small rural industries, trades, and allied activities that contribute to the rural economy. Based on the nature and purpose of loans, the credit provided by commercial banks in rural areas can be classified into the following categories. Number one is the short-term finance. Short-term finance helps rural households meet immediate and seasonal financial needs. These loans usually have a repayment period of less than 1 year. Rural families often face irregular income due to dependence on agriculture or daily wage work. Therefore, they borrow short-term credit for purchasing seeds, fertilizers, pesticides, and feed for livestock, meeting consumption needs during off-seasons, financing small-scale trading activities or petty shops, managing emergencies such as health expenses, paying school fees for household bills, minor repairing of farm equipments, machineries, or houses. The next is medium and long-term finance. So commercial banks also provide medium and long-term loans to support capital formation and durable assets creation in rural areas. Medium-term loans are generally given for 1 to 5 years, while long-term loans may extend up to 15 years. These loans are used for activities that enhance future productivity and income, such as purchase of cattle, drip irrigation system, or horticultural development, construction of cattle seed, storage facilities and fencing, acquisition of small vehicles like tractors, auto rickshaws, delivery vans, or transport services, expansion of rural industries such as handloom, carpentry, pottery, or small mills, rural housing loans, and sanitation development. The third category of credit provided by commercial banks to farmers is indirect finance. Indirect finance support institutions and organizations that in turn helps rural borrowers. Bank lending here improves the overall rural credit ecosystem. It includes loans to cooperative societies, self-help groups, farmer-producer organizations, loans to marketing committees and rural input supply agencies, capital subscription in RRBs, then finance to warehousing corporations and state agencies engaged in food procurement, credit for agro-processing units like cold storage, rice mills, milk collection centers, financial support for distribution, storage and movement of essential goods, etc. So indirect finance strengthens the supporting infrastructure behind rural livelihoods and ensure rural producers receive fair market opportunities. The next major institutional sources of rural and agricultural credit in India is the regional rural banks. By the mid-1970s, although cooperative credit institutions had been operating for many years and major commercial banks had been nationalized in 1969, the government realized that institutional credit had still not reached the proper and more remote sections of the rural population. To review this issue, a working group was set up in the year 1975 under the chairmanship of Sri M. Narasimham, tasked with assessing the flow of rural credit and identifying why vulnerable groups like small and marginal farmers, landless travelers, rural artisans, and small entrepreneurs continues to depend on moneylenders. The working group examined the functioning of cooperative and commercial banks and identified several weaknesses. The most critical issue was the geographical unevenness in credit distribution, where many backward and tribal areas remained outside the coverage of formal financial institutions. Additionally, commercial banks lacked grassroots familiarity with rural customers and were mostly urban oriented, with cooperatives often suffered from limited financial capacity, mismanagement, and political interferences. The group concluded that the existing structure alone could not effectively address rural credit needs and that a dedicated long-term institutional mechanism was essential to uplift the weaker sections economically. Accordingly, the regional rural banks were established in India on 2nd October 1975 under the provisions of the Regional Rural Bank Act of 1976. The primary objective behind the creation of RRB was to provide financial services to rural and agricultural sector, particularly for people who had limited access to formal banking system. They were aimed at improving rural development, providing credit to small farmers, artisans, and rural business, and boosting economic activity in rural areas. In 2005, the government initiated the merger of RRBs to strengthen their capital base and enhance their outreach. As a result, the number of RRBs was reduced from 196 in 2005 to 56 by 2016. Further, consolidation brought the total down to 43 by 2020, improving their efficiency and financial stability. In November 2024, the Indian government proposed a significant consolidation plan to merge the existing 43 RRBs into 28 entities. This initiative aims to create one RRB per state, thus streamlining operations and reducing administrative cost. Of the total loan extended by RRBs, about 46% goes to agriculture. About 90% of loans are extended to priority sector. And of the total loans, about 79% is extended to weaker sections. RRBs plays a significant role in extending microcredit. They account for 30% of the self-help group accounts and 26% of the loan amount. About 92% of the branches of RRBs are in rural and semi-urban areas. Though RRBs have 14% of the total bank branches in the country, their shares in total numbers of the rural branches is about 29%. Many RRBs have branches in remote areas and they are providing financial services to vulnerable section of the society. To operate effectively, RRBs depend on several key sources of funds. Let us look at the major sources one by one. The first one is share capital. The capital of RRBs comes from three stakeholders. The number one is the central government, who contribute 50%, the state government, which contribute 15%, and the sponsorer bank, which contribute rest 35% of the total share capital. The next source is public deposit. RRBs accept deposit from the rural public, such as savings account, current account, and fixed deposits. This not only mobilize rural savings, but also deepens financial inclusions. The next source is borrowing from sponsor banks. To bridge temporary funding gap, especially during agricultural season, RRBs borrow from their respective sponsor banks. These borrowings helps maintain smooth lending operations. The next source is refinance from NABARD. NABARD provides refinance facilities to enhance agricultural and rural lending. This strengthens the bank's credit delivery capacity in rural areas. The Reserve Bank of India gives special financial support to RRBs. RBI provides refinance assistance at a concessional rate that is 2% below the bank rate, treating RRBs at par with cooperative banks. This helps RRBs extend affordable credit to rural borrowers. To ensure public confidence, deposit in the RRBs are insured by the Deposit Insurance and Credit Guarantee Corporation, that is DICGC. Up to the insurance limit, depositors are protected even if the bank fails. This enhances the trustworthiness and stability of the rural banking system. So this was all about the sources of funds for the RRBs. Let us discuss about the functions of RRBs. So the functions of RRBs can be broadly classified into agricultural and non-agricultural functions. So some of the agricultural activities are: number one, credit support to farmers. RRBs provide loans and advances to small and marginal farmers, agricultural laborers, farmers group, and cooperative societies. These loans helps finance productive agricultural activities, contributing to employment generation and enhancing rural economy. The next is strengthening rural market. By financing agricultural marketing societies, RRBs help ensure that farmers receive fair prices by selling their product at the right time and at right place. The next is doorstep banking. RRBs deliver essential banking services in remote areas not reserved by commercial banks. They mobilize rural savings and channel them into productive sections, reducing dependence on informal moneylenders and curbing harmful spending practices. Now let us discuss the non-agricultural activities. So number one is loan to artisans. RRBs support rural artisans who lack financial resources by offering affordable credit for raw materials and equipments. This helps improve production quality and income levels. The next is support to small entrepreneurs and self-employed persons. The RRBs extend low interest loans to small businesses engaged in trade and services to boost entrepreneurship and enhance livelihood opportunities. The next is consumer loans. RRBs provide credit to weaker sections and small farmers to help meet essential consumption needs. The next is poverty alleviation. RRBs implement various government-sponsored programs aimed at raising the income and living standard of people below the poverty line by creating employment and promoting economic inclusion. Despite their importance, RRBs encountered several challenges. They are: number one, political interference. Loan disbursements are often influenced by political factors rather than genuine financial assessment. The next is poor loan recovery. Due to low repayment rate, RRBs face financial constraints, limiting their lending capacity. Then, limited operational flexibilities. RRBs have to follow stringent government regulations and interference from sponsoring banks, making them less competitive than commercial banks. The next is inadequate capital base. Many RRBs struggle with financial sustainability due to insufficient capital. So this was all about regional rural banks. The next institutional source of credit for rural India is cooperative banks. So cooperative banks are the oldest institution providing institutional credit in rural India. A cooperative bank is a financial institution that is owned and operated by its members. They are based on principles of cooperation, mutual aid, and shared ownership. The structure of cooperative banks in India, if you look at the structure, we have two types of institution. One is urban cooperative bank, another is the rural cooperative credit institutions. Again, rural cooperative credit institutions are of two types. One is providing short-term credit, another is providing long-term credit. So from the chart, we can have an idea about the structure of cooperative credit institutions in India. So let us first discuss the short-term credit institutions, since these are the most popular form of cooperative banks found in rural India. So this institution has a three-tier structure. The primary credit societies are at the base level, that is at the grassroots level. The central cooperative banks functions at the district level, and the state cooperative banks are at the top, at the state level. The primary credit societies are village level institutions that works directly with rural residents. It encourages agriculturists to save, accept deposits from them, makes loans to deserving borrowers, and collect repayments. They provide short and medium-term credit to the farmers. Besides credit, they also help farmers by supplying seeds, fertilizers, agricultural equipments, marketing of farm product, etc. Primary agricultural credit societies are at the lowest unit in the three-tier structure. A large number of them, however, face several financial problems, primarily due to the erosion of own funds, deposits, and low recovery rates. According to a Reserve Bank of India report published on December 27, 2022, the total number of primary agricultural credit societies stood at 1,02,000, of which only 47,297 were profitable as of the end of March 2021. The next is the central cooperative banks, which constitute the middle tier of the cooperative credit institutions. They function as independent entities, as state cooperative banks do not exercise control or supervisory authority over their operations. Central cooperative banks functions at the district level and provide a link between primary society and the state cooperative banks. The primary societies borrow money from the state cooperative through central cooperative. The central cooperative banks draw their funds from share capital, deposit, loans from the state cooperative banks, and where state banks do not exist, from RBI, NABARD, and commercial banks. Deposits constitute the major component of sources of funds, followed by borrowings. The main functions of CCB, that is Central Cooperative Bank, is to finance the primary credit societies. In addition, they carry on commercial banking activities. They also act as balancing centers, making available excess fund of one primary credit society to another which is in need of them. The apex institution of this structure is the state cooperative banks. The state cooperative banks are the apex of the three-tier cooperative structure, dispensing mainly short-term and medium-term credit. State cooperative banks is the principal society in the state which is registered or deemed to be registered under the Government Societies Act of 1912 or any other law for the time being in force in India relating to cooperative societies. The primary objective of state cooperative bank is to finance the other societies in the state which are registered or deemed to be registered. The principal functions of state cooperative bank is to assist the central cooperative banks and to balance excess and deficiencies in the resources of central cooperative banks. These functions of the apex bank to act as a balancing center is important since direct lending is not allowed among the central cooperative banks. The connection between the state cooperative banks and the primary cooperative societies is not direct. The CCBs, that is the central cooperative banks, are acting as intermediaries between the state cooperative bank and the primary societies. The SCBs, that is state cooperative banks, receive current and fixed deposit from its constituent banks as well as savings, current and fixed deposit from the general public and from local boards or other local authorities. Further, they receive loans from commercial banks and seasonal loans from RBI and NABARD. The state government contribute a certain portion of their working capital. So these are the cooperative institutions found in India which provides short-term credit to farmers and the villagers. There are cooperative institutions which provide long-term credit. For long-term credit, land development banks are established. They work at two levels. At the district level, there are primary land development banks, and at the state level, the state land development banks. So state cooperative land development banks, also known as state cooperative agriculture and rural development banks, they constitute the upper tier of long-term cooperative credit structure. Though long-term credit cooperative have been allowed to access public deposit under certain conditions, such deposit constitute a relatively small proportion of their total liabilities. Primary cooperative agriculture and rural development banks are the lowest layer of the long-term credit cooperative, as in the case of SCARDBs, that is state cooperative land development banks. The primary cooperative agriculture and rural development banks primarily depends on borrowings from their lending business. Land development banks provide loans for a period of 10 to 15 years, and at times they are extended up to 20 years. So cooperative credit institutions plays a significant role in the disbursement of credit for agriculture and rural sector and accounts for 45% of the total credit for the rural areas. However, it faces several challenges, including financial constraints such as limited capital base, high non-performing assets, and dependency on government support. Structural insufficiencies like weak management, political interference, and outdated technology further hinder their operations. Loan recovery remains a major issue due to poor repayment culture, lack of proper risk assessment, and farmers' vulnerability to crop failure and market fluctuations. Additionally, regulatory challenges arise due to dual supervision by RBI and state governments, leading to bureaucratic delays, limited outreach, low financial literacy among farmers, and competition from commercial banks and microfinance institutions further weaken their effectiveness. To enhance their role in rural finance, cooperative banks need better financial management, governance reforms, digital adoption, and improved risk management strategies. So this was all about the institutional source of credit. So we'll conclude this video here. In the next video, we'll discuss about NABARD and recent innovations in rural credit and problems of rural credit in India. Thank you for watching this video.